I'm super passionate about the conversation we're bringing here tonight. And I'm going to show you a quick video that Haren's created around his product, and then we'll bring him up on stage.
The S&P 500 has long been the gold standard for index investors, but now there's a simple and more effective methodology than market cap weighted. The IO 100 offers more exposure to the most innovative companies and less to bureaucratic boardrooms with empty suits. The index is built on two fundamental truths. One, that skin in the game matters. And two, a small group of high-impact individuals has always been responsible for the majority of our economic growth. From Henry Ford and John D. Rockefeller to Jeff Bezos and Mark Zuckerberg. To understand the IO 100, it's important to first examine traditional market cap-weighted indices. These indices determine a stock's weighting by multiplying its price by the total number of shares outstanding. In contrast, the IO 100 applies this calculation only to shares owned by insiders. The IO 100 reweights stocks from the S&P 500 based on the value of shares held by founders and other insiders, a factor completely missed by other indices. This methodology favors companies where leadership has a significant personal stake in the long-term success of the organization. In other words, the IO 100 builds a portfolio centered around the visionaries who have shaped our world. These leaders represent the most informed group of shareholders, and incorporating their ownership produces a more robust and strategically aligned portfolio. Backtesting this methodology over the past 2 decades demonstrates its ability to generate significant above-market returns. A hypothetical $10,000 investment in the IO 100 would have far outperformed the S&P 500. The IO 100's strength lies in its divergence from traditional market trends. Instead of following the market, it follows the founders who redefine it. Learn more about the Inside Ownership 100 by visiting InsideOwnership.com.
Help me welcome up Haren Bhakta, CEO and founder of Inside Ownership. Haren. It's fun to be on stage with you again.
Yeah, we just did this last week.
We did, and you know what I love? Like, we've had this conversation many times. It never gets old, and you always teach me something new.
Yeah.
Every time I get more information from you, and it's inspiring to hear all of the passion that you have around this. So start us off by telling us how did you come up with this idea? Where were you? What were you doing?
Yeah, so I'm a huge Warren Buffett fan, and I've been attending the Berkshire annual meetings in Omaha since 2017. And I put a lot of my money and my clients' money in Berkshire Hathaway. And in 2024 was the first meeting where Charlie Munger, Warren Buffett's partner, had passed away. And so I was kind of sitting there afraid, what am I going to do with Berkshire Hathaway when Warren Buffett dies? I bought Berkshire because of that trust and belief in Warren Buffett. So I'm sitting there thinking, what am I going to do? And at some point it clicked that the S&P 500 will buy more Berkshire Hathaway when Warren Buffett dies. Now, this is something called free float adjusting that the S&P 500 does. They exclude his shares when they count the size of Berkshire, but when he dies, those shares become free floating. I just thought this has to be the opposite of what anyone would want. Who would want more Berkshire after Warren Buffett dies? In the same respect, who would want more Tesla without Elon Musk? Who would want more Meta without Mark Zuckerberg, right? These guys created the value of the companies. Who would want to invest more so without them?
It's fascinating that, and maybe I'm embarrassed to say, I did not know that. So is that common knowledge for people to be able to hear and go, oh, when the founder leaves the company and there isn't inside ownership, the S&P is going to buy more of it? It doesn't seem like a lot of people know that.
Yeah, most people don't know that. In fact, very smart financial advisors don't know either, and they understand the S&P 500 is free float adjusted, but they haven't made that connection to Warren Buffett passing away, oh, now it's going to buy more.
That has to have something to do with your passion and I feel like you're a Warren fan.
I'm a huge Warren Buffett fan.
Yeah.
Right. Yeah. So this is an interesting slide here. Now, had you invested $10,000 in Berkshire Hathaway in 1965 when Warren Buffett took control, that $10,000 today would be $380 million. Now, this is the point of investing in these genius CEOs, right? The same $10,000 in the S&P would only be $3 million.
Wow.
Yeah, I did an interesting video recently where if Berkshire Hathaway collapsed 99% tomorrow, you still outperform the S&P. You'd have $3.8 million and you still beat the S&P 500. It's crazy how well he's done.
And that's wild because what you're saying is that even all the money that you've grown, 99%, it falls, it drops, and you're still outperforming the S&P.
Yeah.
Is that because of what you just shared a minute ago, that the S&P buys more of the companies that don't have, they own more of the companies
That's
that don't
right.
have that inside ownership?
That's right, exactly. So you can have two identical companies where one is heavily owned by insiders and the other one is not. The S&P will favor the one that's not, and it's the opposite of what we should want.
I feel like there should be a big disclaimer on that
Yeah.
to the average investor who's buying the S&P 500 to know that you're going to carry more of that.
Right.
Interesting. So you had this epiphany and you started to think, this is what I want to own more of. So did you automatically start thinking of the companies that had this inside ownership?
Yeah, so I'm sitting there thinking, wow, if I just invested in the ownership, I would have made so much more money. So when I came home from Omaha, I looked around for the data. I couldn't find it. Nobody, there's Capital IQ, there's Bloomberg Terminals, there is FactSet, all these data providers. Nobody had the ownership data. It's crazy. So I had to go manually through every proxy filing in the S&P 500 for 20 years. So I had to manually went through 20,000 different proxy filings and captured that data. So the data is there, but no one had aggregated it. So I'm currently the only one with this data. It's easy to find, but I did the work.
I have to, does anyone else realize how lightly he's just like, I just mined through just how many proxies to figure out all this inside data?
ChatGPT, right?
No, yeah, this is in 2024 when ChatGPT wasn't a big thing. It was just getting started.
You bring dedication of investor returns to a whole new level with that.
Yeah.
So tell us about some of those companies. I think you have a unique slide that kind of gives us an idea of all those companies out there that really do.
Yeah, so here's a slide of 19 different companies. Now, each one of these turned $10,000 into over $1 million over the last 20 years. Had you put $10,000 in the beginning and held it, it turned into over $1 million. Now you have like NVIDIA and Netflix, Monster, a lot of different companies. Now, there's only one other thing they all had in common. They all had ownership above 5% before it got started. Now, 5% is a big number because these are multi-billion-dollar companies, so only 5% still makes these people very rich, and they have a lot of skin in the game. So the only thing in common to get these super outlier returns has been ownership.
Ownership every single time. So the research that you've done, it keeps checking out that when you have, look at, was it Celsius? That was 40% universal, huge inside ownership.
Right. When leaders own meaningful stakes in the companies they run, they treat the companies better. They treat shareholders better. They innovate more. They go to sleep thinking about their company. They wake up thinking about their company. And the perfect analogy I like is a hired CEO is like a zoo animal, a zoo lion, right? They get fed every day, whether they successfully hunt or not. They get their base salary, they get their quarterly bonus, and very often a golden parachute. I like to call the owner-operator CEO a wild lion. They're trained to survive. They've learned to operate in the world and create value. And when they don't successfully hunt or innovate, they starve and they feel the pain. And that's what you want in your CEO, to feel the pain of mistakes.
Yes, yeah. And I think, do we have any business owners in the room? Yes. Okay. So I was having a conversation before we started this evening, Penny over there, right? And she was talking about, I think if you're a business owner, you can relate to, have you ever said like, nobody can do it like I do it? Nobody cares as much as I care. And I think you equate that really well to this skin in the game theory.
Right.
Yes.
Yeah. So I read the book Skin in the Game like 6 times. So it was ingrained in me. And when I was there at Berkshire, that's when it really clicked. Right. So skin in the game is night and day difference.
Yes. You experienced that yourself with the whole, you were telling me about the basketball story.
Oh, right.
Yes.
So, yeah. So in my 20s, this is my first experience with skin in the game. Now, in my 20s, I played basketball right here in Cerritos High School. We used to rent out that gym. And every Thursday night. And after the first year, someone had said, why don't we bet a round of beer? The losing team has to buy beer for the winning team. And that changed everything. We were diving for balls, pushing each other, shoving each other, and we just played harder than we ever really played. And it was amazing how different the game was once we bet on the game. And it wasn't that we had to buy my friend a beer, right? It was the fact that we bet on ourselves. And that created that drive. And that's what you want from your CEOs. You want that drive.
And you see that. I mean, when you're talking about the amount of money that you can make when the CEO is invested in it, it makes a huge difference.
Right. And the reverse is true as well. So these are the biggest losers, the biggest value destroyers of the S&P 500 over the last 5 years. So they destroyed the most value within the S&P, and you could see that every single one of them had very low insider ownership. So insider ownership doesn't just capture the winners, it also avoids the main losers. And that's the key, is when you want high returns, avoiding those that are going to be bad performers.
It's almost like you took the S&P, well, it is, right? You took the S&P 500 and you said, well, how do we not carry, it's shocking to me that, Disney is on there.
Right.
You would think that, oh, Disney's this great company to own, right? But you took the S&P 500 and you said, how do we not own the stuff that's dragging it down?
Right. So I asked people to imagine a company, a very successful company run by successful leaders, right? Now, overnight, replace that company with new leadership. Now, is it really the same company, right? And most people would say no, and I would agree it's not, because all a company is a group of people, and you can't just interchangeably change people and expect the company to be the same.
Yeah. That makes sense. And so when you've given us great examples on the upside, Warren Buffett, Jeff Bezos, and Elon. So give me an example from the downside, like companies that somebody's holding in the S&P. I think one of my favorite examples is recently. Anybody ever owned Silicon Valley Bank?
Yeah. So this is Silicon Valley Bank in 2023. It went to zero. Now, most of you probably didn't own the stock, but a lot of you may not know you had exposure to Silicon Valley Bank because it is in the S&P 500, or it was at that time. And a fun fact, it's very rare for a company to go bankrupt while in the S&P, because normally they kick it out and put in a new company. But Silicon Valley Bank happened so fast that they didn't have a chance to, and it went to zero while in the S&P. Now, I have a slide for, this is a snippet which is hard to see, but it's their proxy filing in 2023. Now, insiders owned so little of Silicon Valley Bank that it was represented by an asterisk. So, they didn't own any shares. And, when you don't own any part of the company you're leading, what you do is you aim for the fences. You take on leverage and you be aggressive, because if you hit a home run, you get a big payday. But if you don't, it's no skin off your back.
No skin off your back.
No skin off your back.
Because they had no skin in the game.
Exactly.
Yeah.
Exactly.
Interesting. So this is what you are biting through.
Yeah, this is what you're avoiding.
Well, this is what you were digging up, though, right?
Yes,
And looking for where is the inside ownership.
I went through every proxy filing for all 500 companies over 20 years.
I can imagine you like with an accept and a reject pile.
Yeah.
You're like, no,
Yeah.
right? So you would look at something like this and you would say, no. This does
Exactly.
not go
Yeah.
into.
Well, it's completely
inside ownership.
rules-based, so I'm not actually deciding. I don't pick what stocks go into the index. The S&P 500 gives me all 500 companies. I simply put in the insider ownership data, and the top 100 filter through there. So it's based on the dollar value of how much skin in the game these leaders have.
Okay, and so when you're talking about how much skin in the game they have, if a company has like Celsius, for example, or NVIDIA, they have a lot of skin in the game. Do you invest in that differently?
Right. So the index is proportionally weighted according to their ownership. So the more dollar value that they own, it represents a bigger position in the index.
So it's almost like when we invest in inside ownership, we're investing arms locked next to Elon or Warren or any of these other guys because we're in it with them.
Exactly.
And do you cap that?
Yes. So yeah, that gets complicated. But yeah, it's capped at 5%.
Okay.
Right. So what we don't want is, for example, Oracle, where Larry Ellison owns 40%, or Michael Dell owns 40% of Dell. We don't want too much exposure to these companies, so we do cap the ownership at 5%.
Give us an example, because I find this fascinating, I'm sure you all do, of a company who had the inside ownership and then they left.
Yeah. So this is IBM. IBM in 1984. Now, IBM is the most dominant company to ever exist. And when I say dominance, I mean by relative size. So it was almost 2.5 times larger than the next largest company in the world. So that would be like NVIDIA today being $12 trillion. So it was incredibly dominant. Now, a lot of people don't know this, but it was Thomas Watson Sr. that founded IBM. But it was his son, Thomas Watson Jr., that took IBM public in the 50s. And he ran the company as a CEO until the 70s. And in 1984, he retired. So this is 1984, which it's kind of cut off here. But yeah, this is 1984, peak IBM. And fast forward just 8 years after Thomas Watson Jr. retired from the board, IBM is not even in the top 10. Today, IBM is not even in the top 25. So this is what happens when leadership leave, those responsible for the success of an organization leave, the companies typically erode. And in IBM's case, this was the most dominant company to ever exist. And yet just 8 years later, it had eroded.
Amazing.
Yeah.
And most people probably don't even necessarily know that. It's still in the S&P 500. They're still owning it. It's dragging down performance.
Exactly. Yeah.
But you
so
just kinda
IBM has really gone nowhere for the last 30 years.
So if inside ownership was live back then, I know you have back testing on it, but live back then, you would have been owning IBM up until
Thomas Watson Jr. retired, and then you'd be out.
And so how does that happen? Like, how soon would you get out? When would you know and all of a sudden exit that and bring in another company?
So we follow the S&P 500 rebalancing schedule. So we rebalance every 3 months. Every quarter, the index gets rebalanced. So we go through every proxy filing for every 500 companies every quarter and see if there's updates. And then we rebalance the portfolio that way.
So the longest amount of time then is really 3 months. If you had inside ownership and it was in the ETF and then they left, they sold their shares, the longest it would be there is 1 quarter before you would say it's no longer allowed in our index.
Correct. And to be clear, most positions leave the index when the CEOs or directors, those with the ownership, either die or completely retire. Most of the time, these people, they're not just liquidating the portfolio. So Jeff Bezos is not going to completely sell out of Amazon, or Warren Buffett is not going to completely sell out of Berkshire. What they're going to do is either die or retire.
And so how does that affect?
So when they do die or retire, then they're no longer an insider. and the index will move on from them.
I see.
Move on from those companies.
Okay. What's one of your favorite stories? Like, I'm just curious about one of the equities that you find most fascinating as far as the rise and the fall or the performance.
Right. So this is one of my favorite analogies or slides here. Now, Intel and NVIDIA. In July of 2020, they were exactly the same size. They were both $250 billion companies. They were both chip designers, right? And they were both equal weighting in the S&P 500. Now, Intel at that moment had 7 times the revenue of NVIDIA, 7 times the profits. It had a higher return on equity, and it even earned more cash. It had more cash flow than NVIDIA did. But NVIDIA had something Intel didn't. It had a wild lion as a CEO, a guy who went to bed thinking about his company, waking up thinking about his company. Fast forward 6 years, Intel has underperformed the market. NVIDIA is up more than 2,000%. It's created enormous wealth for shareholders. Mm-hmm. This is the difference when you invest in the wild lion. I think too many professional investors have focused too much on last year's revenues or last year's profits. What they should be looking at is leadership, how much they own, and what that leadership has been able to do. If you look at, for example, Netflix, if you looked at, it was delivering DVDs. So it's not always the current business that's going to create the value. It's these leaders go to bed thinking about their companies, thinking about ways to increase shareholder value, and then they come up with streaming, right?
Yeah.
Blockbuster, for example, didn't want to deliver DVDs because they were making so much money from late fees, right? So when you have no leadership, no ownership, they get locked into a certain way of thinking. And what you want is people who think long term.
It's interesting you bring up, because I haven't heard you talk about Blockbuster before. And obviously, if you have a leadership that isn't invested in the company, and they're focused on that number, the number they have to provide to the street, the number that they have to provide to investors, and not really the growth. Like maybe the late fees were, well, this is revenue building for us.
Right.
It's almost
right.
short-sighted.
And it's almost not their fault. So when you have a CEO who doesn't own a big part of their company, they're judged every quarter. And so they think for every quarter. And that's what they're focused on. But when you have ownership, you can think in decades, right? And Jeff Bezos, for example, he didn't care about producing a profit next quarter. What he did was focus on things to create long-term value over decades. So Amazon didn't show a profit for like 20 years, but it created enormous value for investors and shareholders, right? Because he thought in decades.
So you really have to believe in the...
Right, yeah.
Yes.
So, the people, I'll give you the best example, actually, my dad's younger brother here. He worked for NVIDIA for 17 years, okay? He made out really well. But he was lucky enough to work for NVIDIA, but that's only half the story. He outperformed all his coworkers because he didn't sell. Most people will find good investments. That's not the hard part. The hard part is not selling. So many of his coworkers owned NVIDIA, but then sold it. And this is why SpaceX employees got so rich, is because they didn't have the opportunity to sell. Had SpaceX been public, they would have been trading in and out of their SpaceX position, and they would have missed the big run. So this is the beauty of index funds, is that they don't sell the winners. You hold on to the winners, and in our case, we hold on to the winning leaders, and we rotate out of those companies once those leaders are gone.
It's almost like built-in accountability for you.
Exactly.
You can't pull the trigger and hit that sell button, because going back to one of your first slides with Warren Buffett, like, what are the odds that somebody actually held on to it that long?
Exactly.
Right? Somebody got greedy. Somebody was like cashing in.
Yeah, but there's so many people that held on to Berkshire because they trusted Warren Buffett.
Yeah.
So this is the key, if you want to make long-term value, is the people who knew financials really well didn't make all the money in millions or billions of dollars investing in Berkshire. No, they trusted Warren Buffett. And same with Tesla. people that made money on Tesla believed in Elon's mission, and they held. And that is the key. You find these great leaders and you hold.
Yes. Well, and it's, side note, I was watching an old video of Elon the other day, and it was like 20 years ago when he was talking about SpaceX. And he seemed like delirious. The guy was like, wait, you're going to what? And he was like, oh yeah, mark my words, you know? And it's like, they were showing it because it just went public, right? And you're like, man, now that's somebody you can look back at and go, he was going to make that happen.
Right.
Many people thought he was crazy at the time, probably.
Yeah,
but
and he probably is a little crazy.
Yeah. I want you to talk about the innovation aspect. Like you just said something so key that they're not innovating anymore, and the world has changed. It will keep changing, but it seems like now more than ever, investments and companies depend on somebody that's going to be innovative.
Right. So there's a guy, Matt Ridley, he wrote a great book called How Innovation Works. And what he talks about is innovation works through ownership and feedback loops. So what you want is people to feel the pain of failure, and bad ideas must die, and good ideas must survive. And the only way that happens is when those people making decisions are also the ones working on the problem directly. So the problem with low ownership companies is they kind of outsource all the technology, and they're kind of like on the top overseeing it. But when you have layers of bureaucracy below, innovation dies. By the time that bad ideas trickle up the organization, they sound like good ideas. And the perfect example I have is the invention of the airplane. So all these huge companies had advantages while people were working on creating airplanes. But it was this group of brothers in, I think it was Ohio, who created the airplane out of their backyard. Because it's trial and error, it's experimentation. That's how you get innovation.
Got to be close enough to it.
You got to be close to the process. So Elon Musk, for example, talks to the engineers himself, right? He's close to the people working on the actual problems. And that's how innovation really works through an organization. You mentioned Intel. Let me touch on Intel a little bit. So Intel, had you invested $10,000 in Intel in the 70s when Andy Grove was the CEO, by the time he retired, that $10,000 would be several million dollars. Now, in 1998, Intel, Andy Grove retired. By that time, almost every computer in the world had an Intel chip in it, right? He retired in 1998. Fast forward 27 years from his retirement, 1998 till now, Intel stock has done nothing. So this is what happens when those responsible for the success of an organization leave, the companies change. It's not even the exception, it's almost the rule that when the leadership responsible for the success leave, is not the same company anymore.
Well, I think kind of jumping on that, you talk about the innovation cycle. I think, if you look at Kodak, great example. They actually invented the digital dial, and they purposely shelved it because at the time, their leadership wasn't prepared to take on that risk. And I think when you talk about innovation cycles, you can tie it back into, your metaphor. A wild lion is willing to take a risk that a caged lion simply will not.
Exactly. Now, I haven't studied the ownership of Kodak, which I should actually, but I know Kodak has a long history, so I'm highly positive that Kodak was run by a zoo animal.
How often are you changing the portfolio, meaning kicking the companies off and bringing new ones on?
So it's rebalanced every quarter, every 3 months. The companies, we go through the proxy filings every 3 months and see if there's updates and rebalance the portfolio accordingly.
So you're doing this research that you did for the last 20 years every 3 months, kind of?
Correct. Well, correct, but I don't have to go back. I only have to look at the current day companies. When I created the index at first, I had to go back 20 years.
One more question. I wanted to know, so what is it that where are you at right now with this fund? And what's your projection for what's your goal for 5, 10?
Yeah, so we created the one ETF now. We have one ETF that trades on the stock exchange that anyone can buy. We use the S&P 500 and taking the top 100 from there. But we're going to have inside ownership indexes for every market in the world. So we'll have Japan, Europe, China. Every market, every index fund should have an ownership-weighted alternative for investors.
So, in a boardroom, one individual, like a CEO or CTO, or who?
That's a good question. So, okay, you have a board and you have C-level executives. Those are called the insiders. Typically, it's around 15 to 20 people, but that number is unimportant because all the ownership in a company is usually by one or two or maybe at the most three people. For example, Google, you have two founders who own all the stock. Mark Zuckerberg at Meta, he owns all the stock while the rest of the board really don't own that much. So what we care about is Mark Zuckerberg is still there. Whether this other executive comes and goes is less important. It's immaterial. Same with Tesla, right? We care that Elon's there. We don't care if his CFO or some director is there or not, right? So the ownership is usually tied up between 1 to 3 people max. And everybody else is kind of like ancillary. Does that kind of answer your question?
No, I'm just asking it because you are saying essentially that means it's the founder.
It doesn't have to be the founder. So Warren Buffett is not the founder of Berkshire. He took control in 1965. Howard Schultz is not the founder of Starbucks. He bought Starbucks when it had 11 stores. So it's more concentrated. So it is going up and down more than the S&P 500, but I'll note 2 key notes here. In 2008 and during the COVID-19 crisis when the stock market crashed, those 2 global catastrophic events we've seen in the last 20 years. Inside ownership held up better than the S&P 500. S&P 500 went down more. And it makes sense because high ownership companies have better balance sheets, they have better leadership, and they're more resilient. So it just makes sense that when the world is really going wrong, that high ownership companies will hold up better.
Their money's in there.
Their
They're
money's in there,
protecting
exactly.
it. They are
and
responding
they can adapt
differently.
and change quicker than some of these low ownership companies. Now it doesn't work 100%, but on balance, that's what you want is on balance, this will perform, or at least has performed better in a severe downturn.
I was just going to say, as well as having good balance sheets, they can go get capital because
Ex-
they're very powerful people that have a very big personality.
That's 100% true.
Get money when they need it.
That's 100%, yes. That's 100% true. So if Elon Musk wants money, he can make a simple text message to Larry Ellison and get money. So these high ownership companies have access to more capital when the world is freezing, like in 2008.
Great presentation, but I want to know what's you said the ETF went live. What's the ticker actually, so we can.
Oh yeah, so the ticker is OWN, OWN, and it has an expense ratio of 49 basis points, so just under 0.5%.
So I got a question. Your inside ownership index, you capitalize and you basically say we should bet on companies with a high ownership ratio. And then you had a slide that said if you look at what's destroyed value in S&P 500, it's the ones with the extremely low ownership ratio. So is that basically saying buy, own, and then short everything else?
That's a good, yeah, maybe I'll come up with the ETF for that. Yeah, but in general, I would say if you're picking your own stocks, look at the ownership figure maybe first. And I'm not saying it's the only thing to look at if you're picking stocks, but I think people have not paid attention to that enough.
What percentage ownership do you have of inside ownership?
I have all my money in inside ownership index. Yeah. Yeah. I don't own a single other stock. I have enough diversification from 100 different companies.
You've got skin in the game.
I have skin in the game. That's a good question. We already have published sector-specific indices using inside ownership. So we did S&P 500. Then I did the individual sectors within the S&P. And the reason why I did that is a lot of people ask me, Did you outperform simply because it favored technology companies and technology companies happen to be doing well now? So I launched the S&P 500 technology only index, inside ownership weighted. And that one outperformed the S&P 500 technology only by an even wider margin, because the point is that highly innovative companies require ownership to innovate. And so, yeah, it wasn't that we got lucky, it's that the index itself identifies the super outliers, the super value creating CEOs, and invest more so in those companies.
How'd you pick the 5% cap?
I picked the 5% cap because it's almost the opposite of the S&P. So the S&P free float adjusts at 5%. So if the CEO owns, let's say, 4% of the company, there's no free float adjustment. But if they own, say, 6%, then they start free float adjusting after 5. So it's kind of the reverse.
Will you be available to kind of?
Yeah. So
Yeah.
Let's go back here. Check out our website. Very easy. InsideOwnership.com. I have my email here, Haren@InsideOwnership.com. Feel free to email me.